If you bought Whirlpool of India at its peak, you would be sitting at 71% of loss. Not 7%, it is 71%. That's a stock. It went from 2,765 rupees to under 800 rupees. And it is not some penny stock. This is Whirlpool, the fridge and washing machine in half of the middle class homes in this country. Here is the twist. The company just posted its highest ever shipment month. The revenue is up, the market share is up. So how does the company is selling more? Still, it is crashed 71%. Stick around because the answer isn't the business is broken. It is something the most retail investor missed it. And by end of this video, I will tell you exactly what I am going to do with this stock. Am I buying, avoiding or waiting? Let's check. So without wasting any time, we can quickly get into the video. If you are new to my channel, please do subscribe it. And if you like this video, please do hit like button. Let's go. Why did Whirlpool, it got crashed 71% from its high? This crash is not one bad quarter. It is three problems tagged together. The first one is the parent is quietly walking out. Whirlpool Corp, the US parent, they sold 24.7% of stake in Feb 2024. That's when the crack started. In Jan 2025, they announced plan to cut their holdings all the way down to 20%. Why? It is not because India is falling, because the US parent has its own debt problem and they need the cash. And the market doesn't care about why. It only sees the promoter is leaving. Number two, the block deal that broke the stock. 27 November 2025, a 1.5 crore of share of block deal, which is roughly 11.8% of the company, which is sold at steep discount. The floor price is 1030 rupees. Previous close is 1200 something. That is, institution is saying the fair value lower than you think. The stock, it fell 12% in single session. The promoter holding is down to 39.76% from 75% just 3 years ago. Number three, the margin has been quietly bleeding for years. This is the part nobody talks about. When you look at the operating margin, which is 12% in financial year of 18 to just 6% in financial year of 26, it is something cut in a half. We need to know the reason. It is mainly due to rising input cost, aggressive price wars with LG, Samsung, Voltas. Along with that, few new regulatory costs, e-waste provisioning and energy labels with certain upcharges. Adding on top of that, parent overhang, one shocking block deal and slow margin bleed. That is equal to 71% of crash. One key line for the viewers. This is not a scandal. It wasn't a fraud. It was an ownership uncertainty. Adding on top of that, the real margin problem. There are two very different things and mixing them up is how people either panic sell or blindly buy the dip. Let's jump into fundamentals. Let's start with revenue versus profit. There is a real gap. When you look at the revenue, which is 4,832 crores in financial year of 18 and financial year of 26, which is 8,034 crores. It is up 66% over 8 years. It is somewhat steady. When you check the net profit, it had 351 crores in financial year of 18 to 295 crores in financial year of 26. Basically, it is flat to down despite an higher revenue. That gap is between growing sales and shrinking profit. This is the whole story of the stock. When you look at the return on capital, it is a big red flag. The ROCE was 29 to 32% back in financial year of 19 to 20. These are all something elite numbers, and today it is 11.1%. The ROE has gone roughly 19 to 20% to 7.8% today. For value investors, this is the number which matters most. The company is simply not as efficiently generating a profits from its capital as it used to be. Let's understand, is management is manipulating the profit or not? The cash from operations has tracked the profit closely. The cash flow operations or operating profit ratio is 86 to 129%, which is most of the years. The profits are turning into real cash. The other income is only 2 to 6% of profit before tax. They are not propping up the numbers with one-off gains. What I understand is earning is honest. They are just smaller than before and it is not manipulated. I can see it is genuinely under pressure. Let's check the promoter integrity. No SEBI actions, no scams, frauds, nothing on the record. The parent is the US SEC listed company company. This is an extra layer of scrutiny most Indian small cap doesn't have. They have even signed 30-year brand and tech licensing deal. So even ownership falls, the technology relationship stay intact. This is an reduced commitment story, not an dishonest management story. Let's understand the debt, a total non-issue. Borrowings are almost zero for every single year. 71 crores against of 4,034 crores of reserves as per financial year of 26. This is one of the most debt-free consumer durable companies on the exchange. Let's understand the cash flow. One number that looks scary but isn't now. In financial year of 26, it shows a massive 2,032 crores outflow in investing activities. No need to panic. This is mainly 100% of buyout of subsidiary called Elica India. Plus, there is a treasury deployments and it is not a cash crunch. A free cash flow stayed positive even in that year. This is most important. Let's understand the demand check. Is anyone actually buying the Whirlpool products? The Whirlpool, it hits the second market share in fridges and washing machines. They have multi-brand outlets by March 2026. But the direct cooled refrigerator volumes, it fell the industry wide. This is due to a regulatory changes. AC business is the bright spot. 1 lakh plus unit in March 2026 alone, which is growing 50% in positive, but still a small piece of revenue. The Elica, basically a subsidiary, it grew 30% of the revenue and the profit is 48%. It is the fastest growing part of the business. What I understand is the demand is soft and it is not collapsing. The full year sales, it grew 1.4%. That is the real growth story right now. Let's understand the valuation. After the 71% of the fall, is this actually cheap now? Let's check. The Whirlpool PE is 32.4x. The peer medium for the category, which is 45 to 50x. So it's a real discount, right? When you look at the Whirlpool price to book value is 2.4x. The peer medium for this is 6 to 8x. Obviously, it is a real discount. But here is the catch. The ROE is 7.8%. It is roughly a third of what peers like Blue Star or Symphony deliver. Your lower multiple is partly justified and not automatically a bargain. 32x PE of a company, the growing sales is just 1.4% and the profit is down at 11% on certain trailing basis. That is still not a classic cheap stock in an absolute terms. There is a real trigger to watch. The operating margin, it recovers back to 8 to 9%. That is what actually to re-rate the stock. That is not just the stake sales news fading. Okay, we have come to the final part of the video. What is my opinion about this stock? Let me walk you through this the way I actually think about it. There are 4 steps. Step number 1, what exactly the fundamentals tells you. The books are honest, but the returns are genuinely weakened. The ROCE is 32% to 11%. The operating profit margin is 12% to 6%. That is a real decline in the business quality and it is not a noise. Step 2, what's the price actually discount for? The Whirlpool, it trades at 32x of PE against the industry averages 45 to 50x. The market has already discounted it for the weaker ROE. This part is already priced in. Step 3, the one thing that is not priced in, that is called the parent stake sale. And it is not a fundamental factor. It is an ownership and the supply factor. No PE multiples can price in. Will there be another surprise block deal in next quarter? That is a binary and a time bound event as well, and not something you can value with the ratio. Step 4, why that changes the decision. You are being asked to an unpriceable event driven risk. I mean, a surprise block deal, it has been stacked on top of an already priced in fundamental risk. 2 risk stacked is worse than 1. I can underwrite the fundamental risk. I can't underwrite the ownership risk. I can only wait for it to resolve. So I will wait. Once the stake sales actually complete, I am left with just a fundamental risk, which is normal, a value things to underwrite and worth revisiting at this point. Until then, this stay a watch list name for me, not a portfolio name. This is not something a buy or sell recommendation. Always do your own research and analysis before acting on anything you hear here. That's all I have. If you like this video, please do hit like button. We'll see you on another good video. Till then, bye.